Welcome. It's fascinating to think that if you were born before January 10, 1973, you've endured 3 episodes where the American stock market nosedived by about half. From January 1973 through October 1974, the S&P 500 stock index was down 48%. Between March 2000 and October 2002, the market was down 49%, and the big one, October 2007 to March 2009, stocks were down a jaw-dropping 57%. The critical point is that these crises were genuine. These weren't thunderstorms but more like hurricanes. One such unforgettable event was between January 73 and October 74, where the combination of an oil embargo, exploding inflation, recession, and a little scandal known as Watergate led to a 48% plunge in the S&P 500. Fast forward to March 2000 through October 2002. Memories of the dot-com bubble bursting, which was probably the greatest stock market bubble of all time. Remember, after the Enron scandal, no one believed any company's accounting numbers. The S&P 500 suffered a 49% plunge during this period. But the technology stocks crashed 80%. Then, we have the haunting period between October 2007 and March 2009. The subprime mortgage catastrophe culminated in the worst recession since the Great Depression, and the S&P 500 went down by a staggering 57%. In a way, 2007 to 2009 was this generation's 1929 to 32 experience. Again, the cry was, "This time it's different." But was it? What is the answer to the following question? Why have stock prices risen over time? At the end of 1972, the S&P 500 index closed at 118. Last year the index closed at 4,770, up 40 times. With all those terrifying events, the best companies in the United States and the world increased their earnings from $6 to $250. Their earnings were up 40 times. Coincidence? Well, why have earnings shot up so much? It helps that the population rose by 50%, but the big things were productivity and innovation. Americans increased their productivity almost 2.5 times in inflation-adjusted terms. But the most significant factor by far was innovation. 9 of the 10 most valuable companies in the S&P 500 today didn't exist in 1972. That's right. The best science fiction writer could not conceive Microsoft, Apple, Google, and Amazon. The personal computer, the iPhone, internet search, and online shopping didn't exist. That's innovation. Dividends have grown far ahead of inflation. As concerned as everyone always is about stock prices, in retirement, we'll strive to live on our dividends. And here, the big story is the rate at which dividend growth has outstripped inflation. From 1972 to 2023, dividends are up 21 times, 3 times inflation. Think of dividends as the cherry on top of your investment sundae, they sweeten the deal. Still, since we're discussing substantial stock price declines, recovery time is a legitimate concern. And so we ask, since the end of World War II, what is the longest time to break even? What might the answer be? Incredibly, the longest recovery has been 5 years and 8 months, again, with dividends reinvested, according to one of the foremost scholars of the capital markets that we have, Jeremy Siegel of the Wharton School, the author of the book Stocks for the Long Run. If there's one key idea that's most valuable to hold on to in declining markets, it's this. As stock prices decline, it is essential to remember that price and value move in opposite directions. As prices fall, things seem to be getting worse. But historically, declining prices have signaled better value in every aspect of our economic lives, except one. That one exception, for some strange reason, is the share prices of the biggest and best companies. As one Wall Street saying has it, the stock exchange is the only place where, when they have a big sale, everyone runs out of the store. The moral of this story is best summed up by Warren Buffett's recently deceased partner, the plain-spoken Charles Munger, who famously said, "If you're going to be in this game for the long pull, which is the way to do it, you better be able to handle a 50% decline without fussing too much about it." These are the 4 ideas I hope you'll take from this presentation. Number 1, the shares of even America's finest companies have experienced frequent price declines. Number 2, some of these declines, driven by genuine crises, have been significant. Number 3, despite these setbacks, leading companies have continuously grown their earnings and dividends. And number 4, their shares have overcome even the most profound declines more rapidly than one might expect and gone on to new heights. Always remember, past performance is no guarantee of future results. With that said, remember that even in the most upsetting times, we always have a choice. We can say, this time it's different, which it certainly was in these 3 crises, and liquidate even our long-term equity holdings. Or we can say, this too shall pass, which, in 4 words, has been the whole message of history in this presentation. Thanks for listening.